Two people, same city, same age, 34, same income. They even live in the same apartment building, just one floor apart. Every morning, they cross paths in the parking lot, both holding the same overpriced coffee, both heading into routines that look almost identical. From the outside, there's no difference between them. In early 2020, both of them were watching the market start to shake. The headlines were getting louder, charts were turning red, and like most people, they told themselves, "This is probably fine." It wasn't. The market dropped more than 30% in just a few weeks, and that's when everything changed. Person A had no emergency savings, around $10,000 in credit card debt. His retirement account was heavily concentrated in a few tech stocks. When his income got disrupted, panic took over. He sold everything near the bottom, locking in a massive loss, and never returned to the market. Years later, he's still trying to catch up. Person B faced the same market, the same uncertainty, but she did something different. She stayed consistent. She kept investing, even when it felt uncomfortable. She understood that when prices drop, opportunities increase. Over time, she accumulated more shares at lower prices. The crash didn't create the gap between them. It revealed it. Because what matters most during a crisis isn't what's happening in the market. It's how prepared you are before it begins. And right now, the environment we're in makes preparation more important than ever. Valuations are still elevated compared to long-term averages. A small group of massive companies is driving a significant portion of market returns. On the surface, everything looks diversified. But underneath, risk is more concentrated than most people realize. Add in global uncertainty, inflation concerns, and unpredictable economic shifts, and you start to see a pattern. These are the kinds of conditions that have existed before major downturns in the past. Now, that doesn't mean a crash is guaranteed, but it does mean this. If something happens, your outcome will depend on what you've already put in place. So let's break down what actually separates people who build wealth from those who fall behind. First, your safety net. An emergency fund isn't just a basic financial tip. It's your protection against being forced into bad decisions. If the market drops and you have several months of expenses saved, nothing really changes. You stay calm. You keep investing. You give your money time to recover. But if you don't have that cushion, everything becomes pressure. Unexpected expenses show up, income becomes uncertain, and suddenly you're making decisions based on urgency instead of strategy. And that's when people sell at the worst possible time. That's how temporary losses become permanent. Second, debt. Here's a simple way to look at it. If someone offered you a guaranteed return of 20% per year, completely risk-free, you'd take it instantly. That's exactly what paying off high-interest debt is. Credit cards charging 20% or more aren't just slowing you down. They're actively working against you, compounding in the wrong direction. Before focusing heavily on investing, eliminate high-interest debt. Because mathematically, it's one of the strongest moves you can make. Third, your behavior during market drops. This is where most people go wrong. When the market falls, your instinct tells you to stop investing, to wait until things feel safe again. But that instinct is misleading. When prices drop, assets go on sale. The market is the only place where people run away when things get cheaper. Historically, missing just a handful of the best days in the market can dramatically reduce your long-term returns. And those best days often happen during periods of uncertainty, right when people are most afraid. If you step out of the market, even temporarily, you risk missing the recovery. And that gap compounds over time. The truth is, no one can consistently time the market perfectly. Not professionals, not institutions, no one. The people who succeed are not the ones who predict crashes. They're the ones who stay consistent through them. Fourth, your mindset. Because this isn't just about money. It's about psychology. When markets drop, fear takes over. Confidence disappears. Every headline feels urgent. Every move feels critical. And in those moments, logic becomes difficult. Human beings are wired to feel losses more strongly than gains. A drop hurts more than a gain feels good. It's not a weakness. It's how our brains work, which is why you can't rely on emotions during volatile periods. You need a plan before things go wrong. Decide in advance how you'll respond. Commit to staying invested. Commit to consistency. Because when panic hits, your future self will not think clearly. Finally, understand this. Every major market crash in history has eventually been followed by a recovery. Every single one. The difference is not whether the market recovers. The difference is whether you are still invested when it does. Some people sell at the bottom and lock in their losses. Others stay patient, remain consistent, and benefit from the rebound. Same market. Completely different outcomes. So if you feel behind right now, maybe you don't have savings yet. Maybe you're dealing with debt. Maybe you haven't reviewed your investments in years. That doesn't mean you've failed. It means no one ever showed you how this system works. Because once you understand it, everything becomes simpler. You don't need perfect timing. You don't need complex strategies. You don't need to predict the future. You just need structure, discipline, and consistency. Build a financial cushion that protects you when things go wrong. Eliminate high-interest debt that quietly holds you back. Stay invested, especially when it feels uncomfortable. And most importantly, stay in the game, because wealth isn't built in perfect conditions. It's built by the people who keep going when conditions aren't perfect. The quiet, consistent decisions you make today will shape your future far more than any single market event ever will. Your future isn't decided during the crash. It's decided by what you do before it ever begins. And if you prepare the right way, the next downturn won't be something you fear. It'll be something you're ready for.